Hello, it's Dr. Trussell again. Chapter 9, we're going to be talking about what they call long-lived assets. This will include things like property, plant, and equipment, buildings, land, etc., and intangible assets. So in Chapter 9, we'll talk about so-called plant assets and how do you account for them, and how do you analyze them. We'll also talk about intangible assets and what they look like on the financial statements. Plant assets are resources that have physical substance. They're used in operations, not intended for sale to customers, and are expected to provide service to the company for a number of years, except for land. This is normally referred to it, and this is the way I always refer to it, as property, plant, and equipment. But it also can be called plant and equipment or fixed assets or just plant assets. The cost of plant assets. Historical cost principle requires that companies record plant assets at cost. And what is cost? Cost consists of all expenditures necessary to acquire an asset and make it ready for its intended use. So it's not just the purchase price, it's everything to get it ready for use. What we call a revenue expenditure is a cost incurred to acquire a plant asset, but it's expensed immediately. And the reason why it'd be expensed because it doesn't help get the asset ready, so therefore it's not part of the asset. The other one is a capital expenditure, and those are costs that are included in a plant asset account because it helps get it ready for its intended use. So what would be cost, for example, of land? What costs are necessary to get the asset ready for its use and therefore included in the land account? Well, obviously the purchase price would be in there, but things like closing costs, you had to pay a title fee, title company, attorney's fees, real estate brokers, accrued property taxes, other liens, etc. Anything to get the asset ready. Assume Haynes Manufacturing Company acquires real estate at a cash cost of $100,000. The property contains an old warehouse that is razed. By the way, razed spelled this way means torn down. R-A-I-S-E-D is raised as lift up, but when you say it this way it means torn down. So it's a warehouse that is torn down at a cost of $6,000, which is $7,500 in cost and $1,500 from salvage materials. Additional expenditures are the attorney's fee $1,000 and the real estate commission $8,000. The cost to be reported is the cost, the cash price, the removal of the warehouse. You had to pay that to get it ready for use, the attorney's fees, and the real estate brokers. All those costs. So it's not just the cash price, it's all those other costs too. Land improvements includes all expenditures necessary to make the improvements ready for their intended use. So the land, you bought the land, you tore down the building and everything. Now just to get the asset ready for use, when you put in driveways, parking lots, fences, landscaping, underground sprinklers, that sorts of things, those things are included as a separate asset called land improvements. The building, all costs necessary to get it ready. Purchase costs would be the purchase price, the closing costs, attorney's fees, real estate brokers, remodeling, replacing the roof, floors, electrical wiring, all that stuff to get it ready. Construction cost, if you're building it instead of just buying it. The contract price plus the payment for architect fees, building permits, excavation costs, etc. Equipment, all costs necessary to get it ready, be the purchase price, sales tax, freight charges, if you're paying for the asset, send it to you, insurance during transit, expenditures related to this. A lot of people forget this one. Assembling, installing, and testing the unit. That's all cost that goes into the equipment account. Those are not expensed. A lot of people want to expense them. They're not. Here's an example. Leonard Company purchased a delivery truck at cash price of $22,000. Related expenditures are sales tax, painting and lettering, motor vehicle license, 3-year insurance policy. The cost of delivery truck. What's included? Well, the cash price, obviously, the sales taxes, the painting and lettering, but not the license, because that's not necessary to get it ready for use, and the insurance policy. You have to have those things, but not as part of the cost. Those are subsequent costs, and so those will be expensed as incurred. Now, how are we going to record the journal entry for that? Debit equipment, that's the 23,820 we saw on the previous slide. The license fee and the insurance are separate. And then we still had to pay for them. They're just not actually in the equipment account. So the equipment account includes all those things except, in this case, the license and the insurance. Depreciation is the process of allocating to expense the cost of a plant asset over its useful life. It is not an asset valuation. A lot of people think depreciation means it declines in a value and appreciation means an increase in value. That's true, but that's not the accounting definition of depreciation. It's merely a cost allocation to the periods of use. It includes all those costs, all those assets we talked about before, except not land, because land does not depreciate or wear out. It doesn't wear out. And depreciable because revenue producing ability of the asset will decline. That is, in essence, wears out over time. And you use it or consume it over time. Factors in computing the depreciation include the cost. That's everything we just talked about before. Get it ready for use. The useful life, how long you're going to use the asset, not how long the asset will last, but how long you expect to use it. And the salvage value, at the end of its useful life, what do you think the asset is worth? The asset's value at the end of its useful life. A company can choose among different methods for depreciating its asset. There's not just one way to do it, and here these are examples. We're going to go through 3 in this class. There are others, so you see in the little chart over here there are others, but we will go through these 3: straight line, declining balance, units of activity. 3 different acceptable methods. You can choose whichever one you want to use. So for example, Bill's Pizza purchased a small delivery truck. The cost of $13,000. The salvage value is $1,000. The useful life is 5 years, and its estimated life in miles is 100,000. We're going to compute the depreciation using those 3 methods. Straight line is the easiest one and the one that most companies used. The expense is the same every year. So what we do is we take the cost, subtract out the salvage value to give you what's called the depreciable cost. That is the cost that you're going to allocate over the useful life. So we take that depreciable cost, divide it by the useful life, and that gets your expense. And that expense will be the same for all 5 years. So that's why they call it straight line. It's just straight. It's the same amount every year. So for example, the depreciable cost we just saw is $12,000. The rate's 20%. That is 1 over 5. 1 divided by 5 is 20%. And that'll give you $2,400. And the accumulated depreciation in this column here is the total accumulative from year to year. First year, so it's only $2,400. The book value is the difference between the cost and accumulated depreciation. So this is cost minus accumulated depreciation. Now it's not depreciable cost, it's cost. Now that's going to be, so the journal entry for 2014 is down the bottom here. It is depreciation expense debit, accumulated depreciation credit. This is a contra asset, and it will be the same for every year. Now accumulated depreciation, 2,400 plus 2,400 is 4,800. 4,800 from the initial cost is 8,200. And we do the same thing every year. Add in another 2,400, and notice that we do the same every year. And what's going to be my accumulated depreciation? Notice what it is. When I add up all of my depreciation expenses, I'm getting back to my original depreciable cost. And what's left at the end? The salvage value. But the main point here is every year it's the same. Another method is called the declining balance method. It's what's called an accelerated method. That means that there'll be more expense in the early years than the later years. So there's a decreasing annual expense. Double declining balance is double or twice the straight line rate. And the rate is applied to the book value, not the depreciable cost. So the beginning book value, not the depreciable cost, but the beginning book value is at the beginning of the year. Remember, book value is cost minus accumulated depreciation. At the beginning of the year, it's 13,000. The declining rate is 40% because it's twice the straight line rate. 2 times 20% is 40%. And so my annual depreciation expense is 5,200. Accumulated is 5,200. The book value is 7,800. Now the beginning book value is going to be, well, first of all, my journal entry. It's the same journal entry, just different numbers. Now my beginning book value is what? It's going to be the cost of 13,000 minus the 5,200 accumulated depreciation. So my beginning book value comes over here, and then multiply that by 40% is 3,120. And my accumulated depreciation, remember that is just the cumulative from year to year. So 5,200 plus 3,120, and then 13,000 minus accumulated depreciation is 4,680. That becomes my beginning book value, and we keep going from there. Times 40%, annual expense 1123, that's 11,315. Accumulated depreciation by book value. Now in the last year it's a little bit tricky because I have to in essence force it in this last year here, and that's down here at the bottom. If you look at the bottom of the slide here, because we know that the book value needs to be $1,000, so the accumulated depreciation has to be 12,000. So 11 to give us our 1,000. So the difference between these two is your 685, and it's adjusted basically as a force figure to make sure that our ending balance is 12,000 and our book value is 1,000. The final method we're going to talk about is called units of activity. Companies estimate total units of activity to calculate depreciation cost per unit. The expense varies based on how much you use it, and the depreciable cost is cost less salvage value, just like with straight line. So the depreciable cost, same problem, was the original 13,000 minus the 1,000 salvage value, and then you take that depreciable cost, divide it by what? Not the useful life in years, but the estimated life in miles. So you expect to drive the truck for 1,000 miles, which means that every mile you drive it, you'll depreciate 12 cents. So it's really based on how much you're using the asset. So if you use the asset for 15,000 miles, 15,000 times 12 is $1,800. And so that's your annual depreciation. Okay, so let's take a look at how this works out for the entire life of the asset. We're going to take well, it says hours used, but this is actually miles, right, from the previous example. This is the miles. So we take the miles used times the rate per mile. Again, they got this is mile. And that'll be our annual expense, which we add it from year to year to get our accumulated depreciation. And then we take our cost of 13,000 minus accumulated depreciation to get our book value. And then we go every year, and that is the journal entry we've always been doing. And every year we take the miles that we used times the rate. So nothing changes except the miles per hour, miles used, excuse me. 30,000 times 12 cents is 3,600. And then remember, accumulated depreciation is just add those together. And then our book value is cost, 13,000, minus accumulated depreciation of 5,400 gives 7,600. And then we just keep doing that from year to year. It's the same. Same thing every year. And we end up with $1,000 at the end. The main thing there is that the depreciation expense will fluctuate based on how much you use the truck. So this slide compares the three methods. This is the depreciation. This table up here is the depreciation expense per year. Notice that the straight line method, it's exactly the same every year, which is represented by the red line in the graph, and see how it's straight. The declining balance, it decreases every year, so that is represented by the blue line, which is right here. And then the units of activity fluctuates based on mileage cost. So it kind of goes up and down, represented by the green line right here. And so it goes up and down. And you can revise. You might think, well, what if I say it's going to last 5 years but it only lasts 4? Or I thought it was going to last 5 and it's really going to last 8. You can revise it. And so what you do when you revise it is you account for in the period of change. We call it a change in estimate, and we do not have to handle it retrospectively. That is, we don't have to go back and change what we've already done. Just from this point forward, we'll use the new method. It's not considered an error because it's new information became available. Here's an illustration. Arcadia HS purchased equipment for $510,000, which was estimated of useful life of 10 years and a salvage value of $10,000. Depreciation has been recorded for 7 years on a straight line basis. In 2014, which is year 8, it's determined that the total life should be 15 years. Instead of the original 10, it'll be 15 years, and the salvage value is $5,000 instead of the original $10,000. And the question is, what is the journal entry to record the correct prior year's depreciation? And then depreciation for 2014. Okay, so from years 1 through 7, what do we do? Okay, we record on the original depreciation, 510, and the 10-year life. But to correct prior years, we do not have to make any entry to correct. What we did was fine, but from this point forward, 2014 forward, we're going to use the new estimate. And what is the new estimate? Okay, first of all, what have we been doing? This is what we did at the top here, is what we had been doing. This is straight line depreciation. Cost minus salvage value is the depreciable base divided by the 10-year life, gives you 50,000 a year. We did that for 7 years because it's straight line, it's the same every year. That means my accumulated depreciation is 350,000, which gives me a book value of 160, which is the cost minus the accumulated depreciation, which came from up here, gives me a book value of 160,000. I'm going to take that and allocate it over the new period. Well, so my book value in essence is now like my cost. Subtract out my new salvage value, and that gives me a new depreciable base, and divide that by the remaining life, and it gives me a new depreciation of 19,375. So for years 8 through 15, I'll use that depreciation expense. Now, what happens for expenditures that we make during the useful life? Okay, so you have that delivery truck. Well, you've got to change the oil, or you got to put new tires on it, or you have to overhaul the engine, that type of thing. What do we do with those expenditures? Well, we set them into two categories. They are either what we call ordinary repairs, which are expenditures to maintain the operating efficiency and productive life of the unit. There we debit repairs or maintenance expense. That is like an oil change. That's just maintaining the way it's supposed to be. Then we have what are called additions and improvements. Those are costs incurred to increase the operating efficiency, increase the productive capacity, or increase the useful life. In that case, we debit the plant asset, not repairs and expense. In other words, that's called capitalizing. So we'll capitalize that rather than expense it. And what we have called impairments of value, what happens if the asset value declines and is considered permanent? So we don't overstate the assets on the books. We can write the asset down to its new fair value during the year which the decline in value occurs. If it declines in value, it's only temporary, like just normal changes in the real estate market, then we don't do that write down. Only if it's permanent do we do that. Now, plant asset disposal. How do we get rid of a plant assets? We can do it in 3 ways. We can retire it, sell it, or exchange it. And the way we have to do it in all 3 cases is we record the depreciation up to the date of disposal, and we eliminate the asset from the books by debiting accumulated depreciation, that gets it off the books, and crediting the asset account, that gets that off the books. So for example, the sale of plant assets, we're going to compare the book value with the proceeds. How much did you get when you sold it? If the proceeds exceed the book value, then a gain is recorded. If the proceeds are less than the book value, we sell it at a loss. Here's an example. July 1st, 2014, Wright Company sells office furniture for $16,000 cash. The office furniture originally cost $60,000. As of January 1st, it had accumulated depreciation of $41,000. Depreciation for the first 6 months is $8,000. Prepare the journal entry to record depreciation up to the date of sale. All right, that's our regular journal entry for depreciation. Just we're not doing it as an adjusting entry because we're selling it not at the end of the period. So we have to do this sort of catch-up entry to get depreciation through the sale date. Then what we do is we compare the cost less the accumulated depreciation to get the book value, the date of disposal. Compare that to the proceeds. Since the proceeds are, compare the proceeds and the book value, notice that the proceeds are greater. We sold it for more than we had on its books, so therefore it is a gain. Well, we have to record the $16,000 proceeds, the cash proceeds. We have to remove the accumulated depreciation, that's the $49,000. We have to remove the equipment, that's the original cost here. And then we have to record the gain, which is the $5,000 here. Now we're going to change that same example slightly. Instead of selling it for $16,000, let's assume they sold it for $9,000. Exact same process. Take the cost minus the accumulated depreciation to get the book value. That's the same as the previous example. Compare that to the proceeds, which are now $9,000, and you get a loss in this case. Why a loss? Because the proceeds are less than the book value. You sold it for less than how you had recorded on your books. So that is a loss. So therefore we have the cash of $9,000, the accumulated depreciation just like the previous example, but now instead of a gain we're going to have a loss. There's our equipment, and we have a loss on disposal of plant assets. Retirement of plant assets. If we just retire it, we're just removing it from the books, so no cash is received. We're just in essence kind of scrapping it, if you will. We're going to debit accumulated depreciation and credit the asset account. Assume Hobart Enterprise retires its computer printers, which cost $32,000, and the accumulated depreciation is $32,000. What's the journal entry? All we have to do is remove the accumulated depreciation and the printing equipment. But look at this question. What happens if a fully depreciated plant asset like that printers we just saw is still useful? If it's still useful, we do not make this entry. We just keep it on the books because we're still using it. Now let's analyze plant assets. One way to do that is a ratio called return on assets. We take the net income divided by average total assets. So for example, JetBlue had net income of $86 million, and divided by the average total assets, it's 1.3%. So that means how much net income is generated by each dollar of assets. So it's like saying for every dollar of asset you have invested, you get 1.3 cents of income. Now compared to the Southwest is a little bit less, but the industry average is a little bit more. Airlines tend not to have a big return. Another one is called the asset turnover, which indicates how efficiently a company uses its assets to generate sales. So we take net sales and divide it by average total assets. So notice the difference here is it's net income in the previous one, net sales in this one. So this tells you how many times, or how efficiently, how many times they sell their assets during the year. That's why they call it turnover. So for example, JetBlue 66 times means for every dollar of assets they have, they get 66 cents of sales. Or another way of saying that, they sell their assets 0.66 times during the year. It is lower than Southwest and lower than the industry average. So JetBlue is not doing a very good job in terms of efficiently using its assets. A higher number is better, means more efficient. And then the profit margin, we've seen this before in a previous chapter, and we're going to kind of modify it a little bit. If you remember from the previous chapter, profit margin is net income divided by net sales, where the asset turnover we just learned in this chapter is net sales divided by average total assets. Now if you multiply those two together, it actually equals the return on assets. Why is that? Because the return on assets is net income divided by average total assets. But look, if you cross out your net sales, what do you get? Net income divided by average total assets. So it's a way of breaking down to see what is driving your return on assets. So for JetBlue, we multiply the profit margin times the asset turnover. So why is the return on assets low? Well, they have a very low profit margin and they have a low turnover, both of which are low. So they're not making much profits and they're not efficiently employing their assets. So both of those ratios are low, and so you can evaluate it accordingly. The second category we talk about in this chapter are intangible assets. As the name implies, they're not tangible. There's no physical substance. What are they? They're rights, privileges, and competitive advantages that result from ownership of long-lived assets that do not possess physical substance. They may have a limited life or an indefinite life. Common types that you'll see: patents, copyrights, franchises, trademarks, trade names, goodwill. For example, a patent, when you invent a product or invent a process, then you can get a patent on it which protects it from other people using it. And same thing is true if you write a song or write a book, you can get a copyright on that. A trademark would be like the McDonald's golden arches, right? Those golden arches are a trademark, and so they I didn't draw a very good golden arch, did I? But those are protected. No one else can use that. The trade name McDonald's, goodwill, etc. How do we account for them? Well, limited life intangibles, those that have a limited life, they don't last forever, like a patent, those are going to be amortized. Now, amortized is very similar to depreciation. We call it amortization instead, but it's basically the same thing. And then indefinite life intangible assets, they don't have a specific life, so there's no foreseeable limit on the time the asset expected to provide cash flows. For example, a trade name has no definite life on it, therefore we do not amortize, or we do not write them off over time. So patents give an exclusive right to manufacture, sell, or otherwise control an invention for a period of 20 years from the date of the grant. They capitalize costs of purchasing the patent and amortize it over a 20-year life, whichever is shorter, or useful life. Any R&D costs developing the patent, this stands for research and development, any research and development costs are expensed. They are not put into the asset account. Capitalized means put into the asset account. Legal fees incurred during successfully defending a patent are capitalized to the patent account. So here's an example. National Labs purchased a patent at a cost of $60,000 on June 30th. They estimate the useful life to be 8 years. Prepare the journal entry to record amortization for the 6-month period ending December 31st. So the cost is $60,000. The useful life is 8. Therefore, the annual amortization is $7,500. However, we only use it for 6 months this year, so we're going to record amortization of $3,750, debit amortization expense, credit the patent account. Research and development costs, as I said, those are expensed when incurred. They are not capitalized, they are expensed when incurred. Those things are expenditures that may lead to patents, copyrights, process, etc., but they're not necessarily going to do that. In other words, you can research to find a new drug by a drug company. That doesn't mean it will become a drug company. So those expenses are incurred, are expensed. Copyrights give the owner the exclusive right to reproduce and sell an artistic or published work. So if you write a book, you write a song, you get to copyright that. It gives you right to use the asset for your life plus 70 years. And we capitalize the cost of acquiring it and defending it and amortize to expense over its useful life. Trademarks: a word, phrase, jingle, symbol identifies a particular enterprise or product. Wheaties, Monopoly, Sunkist, Kleenex, Coca-Cola, Big Mac, Jeep, etc. are all trademarks or trade names. Legal protection for an indefinite number of 20-year renewal periods. So we capitalize the acquisition cost, but no amortization because it's an indefinite period of time. Franchise is the contractual arrangement between a franchisor and a franchisee. Toyota, Shell, Subway, Marriott, McDonald's, any of those types of things that are franchise out. The franchise or license with a limited life should be amortized to expense. In other words, if you want to open a McDonald's, you have to pay a big fee called a franchise fee. It could be as much as $100,000, and those are capitalized. But if it has a limited life, then you will amortize it. In other words, you can buy the franchise for only 10 years. But many times you buy the franchise, it has an indefinite life, so you would not have to amortize it. Goodwill includes exceptional management, desirable location, good customer relations, skilled employees, high quality products, etc. It's not the place where you drop off your old clothes. It is, and it's only recorded when entire business is purchased. It's recorded as the excess of the purchase price over the fair market value of the identifiable net assets acquired. In other words, when you buy a business is when you record goodwill. Internally generated goodwill is not capitalized. In other words, those costs that you expend to create the goodwill is not capitalized. It's only when you buy it by purchasing another company. So here is a partial balance sheet for Coca-Cola Company, just showing its property, plant, and equipment and its intangible assets. So you'll see land, building, machinery, containers, etc. And then minus. Notice that accumulated depreciation is a contra asset, means opposite balance. So we subtract to get what we call the net property, plant, and equipment. Now this is millions, so this is $9,561,000,000 of property, plant, and equipment. And if you look at their trademark, their intangible assets, $12,828,000,000 of intangible assets. And what they have is trademarks, goodwill, and other. Let's look at IFRS. IFRS, like GAAP, capitalizes all direct costs of self-constructed assets such as raw materials and labor. IFRS does not address the capitalization of fixed overhead, although in practice these costs are generally capitalized. So they're pretty much the same, GAAP and IFRS. But IFRS also views depreciation as an allocation, just like GAAP does, and IFRS permits the same depreciation methods as GAAP. But here's a big difference. We want to focus on the difference. Major difference is that IFRS requires component depreciation. Component depreciation specifies that any significant parts of a depreciable asset have a different estimated useful life should be separately depreciated. Component depreciation is allowed under GAAP but rarely used, where it's required under IFRS. IFRS uses the term residual value rather than salvage value. IFRS allows company to revalue their plant assets. This is a big one, to fair value at the reporting dates. Companies that choose to use the revaluation framework must follow revaluation procedures. So in other words, IFRS can allow you to value the assets at fair value, where GAAP does not allow that. As in GAAP, IFRS, the costs associated with research and development are segregated in two components: research and development. Costs in the research phase are always expensed under both IFRS and GAAP. Here's a big difference between the two. Under IFRS, costs in the development phase are capitalized. They are not under GAAP, they are expensed. And finally, IFRS permits the revaluation of intangible assets except for goodwill, but GAAP does not allow that. Which of the following statements is correct? IFRS permits a revaluation of property, plant, and equipment, but GAAP does not. Research and development costs are expensed under GAAP. Now you might think, well, what about IFRS? No, remember, they are only research costs is expensed under IFRS. Well, that concludes our discussion about plant assets. We'll talk to you soon.